Welcome to Van Podcast number 2. Today's guest is going to be Keith Guericke, and today's topic on the Van Podcast is going to be the REIT, America's Apartment Builder, where we're going to talk a little bit about what REITs do and most importantly, get to know Keith and his career, his distinguished career. So I hope you enjoyed today's Van Podcast number 2. And when you're trying to find this great Van Podcast, you can find us on Apple Podcasts, Google Podcasts, Spotify, YouTube, and Anchor. So good luck with your search and enjoy today's Van Podcast with Keith Guericke, Vice Chairman Emeritus from Essex Real Estate Property Trust. Well, Keith, welcome. Great to have you here. And for Van Podcast number 2, you follow the great Case Swenson and our number 2 journey. We try to do these once a quarter. So welcome and good morning.
Thank you, Michael. I'm happy to be here, and I think this is going to be an enjoyable exercise.
Yeah. How's the summer going? Pretty good?
Great. Yeah.
You know, before we get into some of the things at Essex, I mean, I know supply chain has been a big problem. I know it's been a big problem for Republic on future deals. I mean, what's your take as someone that's in this industry? How are you feeling about inflation, the supply chain? How's that working these days?
Well, we're all facing the same issues. Lumber prices are skyrocketing. Concrete is expensive. Steel is expensive. And you know, I'm not an economist. I listen to probably all the same economists you listen to, and half of them say this is transitory and it's going to be done in 9 months or a year, and some are saying we're in for a longer haul. So I'm more inclined to believe that as the economy starts up and we're all getting back in, and all this stimulus money has been thrown at the economy, that it will it is going to spike now, and it's going to abate. That's my belief and my hope. So we'll see.
Yeah, I tend to agree with you. And if we can have some sustainability of just, dare I say, normalcy to where we don't have any start or stops. I guess now looking back and you think about our industry, an apartment industry, and in some cases and projects that you and I are involved with, they stop construction of projects in some cases at the most critical stage. So I guess maybe in hindsight, we shouldn't be so surprised that a restart has created kind of a logjam of supply, and not just supply, but men and women labor and all of those things. I guess that's for me now looking at it pragmatically, that had we have just maybe carried on a little bit more, especially in our industry, maybe we wouldn't have this spike in materials and supplies. We were already seeing that anyway. I don't know if it could have been avoided.
Yeah, unfortunately or fortunately, we compete with the single family home builders, and the pandemic has driven many people to want to own their own home away from the urban centers. So I'm involved with a home builder, and the number of homes they're selling has almost doubled this year, from like 6,000 homes to 10,500. So, that's an incredible increase for 1 year. And so they're using tremendous lumber, and it's not just them. I mean, every home builder out there is ramping up. So the whole, there's lots and lots of demand for this material that we all need to create homes. I mean, yeah.
Yeah, it's a good, interesting point. I mean, the home builders now, for a while there, it seemed like, and I've been reading this a lot of the home builders can only find land maybe in the Central Valley, or, in, of course, the Arizonas, and other parts of the country, the Boise, Idahos, Austin, Texas. And so we here in California were more along the lines of, let's build inward and inside of transit nodes and urban centers. And Essex, I know, has had a fantastic strategy of coastal investment, especially on the west in these major metropolitans, the Seattles, the San Diegos, the Los Angeleses, the San Jose's. Are you concerned that we might see a softening potentially for demand in these cores, understanding where this has gone, and your point about the home builders?
And that's interesting, because there's a lot of articles in the newspapers and other places talking about the outmigration from California, not just from the city centers, but from California. And, what we're tracking, what we're seeing, that's really not true. So we're seeing people from the urban cores, from the San Franciscos, from the San Jose's, but they're not moving to Austin. And there's, I don't know, 6%, or there's a percentage that's going to Austin and to the other, some tech centers that have the technology companies. But what we're really seeing is we're seeing people move from San Francisco to Concord, to the Alameda County, to the outer counties. And it's partly because if you think about it, all of the restaurants, the entertainment industry is just shut down in the urban areas, and a lot of the people that work there were maybe working two jobs, and they could afford to live in San Francisco. They can't. They couldn't afford it, so they're moving back out to areas that are less expensive. But as the economy opens up, as restaurants open up, they don't want to commute, and even though we have BART, it's still it's much easier if you're living in near your job. So we're seeing that come back. So to answer you, am I worried that it's going to soften? It's cyclical, and I think we're gonna see strength come back. We're seeing rents come back in our markets, just because demand is coming back. So yeah, I think the death of California has been way overplayed.
That's true. God bless California and the Republic of California for sure. I couldn't agree with you more. And to your point, Republic is pivoting a little bit as this cycle kind of plays out. To your point, there is a little bit of migration to these other, what I would say, outlier, areas. You mentioned, the Sacramentos, the Vacaville's, to the north and to the east, and then of course, kind of what's happening, maybe the Monterey counties. We're pivoting a little bit to this build for rent program that we refer to as, and I like to call it more of like lower density commercial apartments. How are you feeling about build for rent? And is Essex, take a look at, for example, a townhome project? Is Essex looking at that now? And are they redefining some of these areas like Fairfield, or mentioned Concord, and some of these outlying areas? Are you starting to have an eye towards those commercial properties? Is that something Essex is on their radar?
No, we're not. We're still focused on the core, close to the jobs kind of new development. I mean, Essex has 65,000 units. Of that, probably 30, maybe 18 to 20,000 have been built by us. The rest were purchased. So, we're continuing to stay close to jobs. We think that that's an important part of our success, that we've been close to jobs. I would tell you that when this whole homes for rent concept started, there was a company formed in Arizona called American Homes for Rent. Sure. And I was on the board of that company, and I thought, I wasn't sure if it was going to be long term. I figured this was coming out of the recession, and buying homes for really cheap, and I thought, well, it's going to either work as a rental, or it's going to work as a selling the homes, flipping the homes, because the value would come back. And the other thing I was worried about is, how are we going to manage homes that are spread all over the country? And that industry, that company ultimately got merged into another company. But that industry is real. It's there. They've actually figured out a lot of ways to improve management, and a lot of the apartment companies are now copying what they did. So they were real, pioneers in the industry.
Yeah, I agree with you. And I think you mentioned in Christopher Todd, I believe, is the latest example in Arizona. They're doing more of the single family build for rent. I think Republic is looking at this, as we do with all entrepreneurial ventures. That, to your point, the core markets, the San Jose's, the San Franciscos, the Oaklands, now even the Sacramentos and San Diego's, Los Angeles, going on, Seattle's, they offer a lot, and there's still a lot to offer for young people, for even empty nesters, and in some cases like San Jose, there's a good balance, despite us not building enough homes always in California. I think San Jose specifically has an existing stock of product, and there's opportunities to put new stock in. It's obviously complicated by a lot of the exactions and what government's expectations of builders are to provide community benefits. Those can be difficult, but I tend to agree with you that the core markets will return. And obviously Essex, you've taken a big position. You've been our partner on a lot of great deals, and we appreciate that. For our listeners, Essex has provided preferred equity, and we've also been joint venture partners with you on hundreds and close to thousands of units, and we appreciate that. So it's nice to hear your perspective that hey, stay the course, and there will be opportunities in the core, right, with fundamentals. So appreciate that. And so Keith, on the subject of Essex, how Essex seems to be doing just so well in its stock, and maybe we could talk a little bit about that. Is were you checking your stock right now, seeing where it's at? I'm going to say it's at 327. He's checking his stock. Let's see, where is it at?
331.
Wow. Well, as a stockholder, I'm excited about that. So, talk a little bit about Essex today, and what's its core strengths, and also, for some of our listeners, maybe the first question I had is, elementary wise, what is a real estate investment trust, and why is it a stock? Because I want to dive a little bit deeper into your roles in creating this as a founder. So, for the listener and the real estate investment trust for dummies, tell me a little bit about what Essex is all about, and how it's been successful.
Sure, Michael. Well, REITs were originally started as a way for essentially widows and orphans to invest in real estate, so they could buy a little bit of stock, and they didn't have to have millions of dollars and be able to put together financing packages, etc. So that was the original concept, and so REITs really didn't get real successful until about 1991, 92, when there was a company that was able to get legislation passed and get it through the IRS. And I'm a little fuzzy. I didn't prepare for this question, but so anyway, they got to the point where existing owners who had property could roll that up tax-free and put it into the REIT. And once that was able to be done, you didn't have to start from scratch. So Essex, when we went public, we had 3,000 units.
Now, how many do you have now?
65,000.
Goodness gracious.
Yeah. So so that was the and then when you think about the big malls, the office REITs, and so each of the real estate segments has their own REITs. So there's office REITs, mall REITs, the strip center REITs, and we talked about the single family homes. There's some single family home REITs. So that REIT, that industry has become a real industry.
So I appreciate that, Keith, that the REIT now has become a real force in the stock market, and your journey to actually create this REIT's pretty fun as well. But before we get there, I mean, what's Essex's kind of game plan right now? I mean, you're probably just had a quarterly earnings report. I mean, anything on the horizon that you've kind of reported out, that new trends that you see that Essex is going to get involved with to continue the stock growth? Because one thing that I've learned about any stock, especially a real estate investment trust, is that it has to continue to grow. That's what makes it so much fun, is that it seems like every quarterly earnings report, there's always something new that you're working on that's going to help grow the stock. And so anything that out of your last report that was of interest that you think is fun that's moving forward?
Well, Michael, unfortunately, our earnings call is this coming week.
Oh, geez, I preempted. What about last earnings call, Q1?
Yeah. No, I think, Essex is, I think what's made Essex successful is that we had a strategy that we created in 1994 when we went public, to focus on West Coast markets, core markets, property close to job nodes. We when the market, and this market ebbs and flows. So sometimes development and new construction is the right thing to do because costs are down and you can build economically.
Mhm.
And sometimes like today, where, we talked about lumber is, through the ceiling, all the costs and labor is in short supply. So it's just very, very difficult to build new supply. And so in those times, we, generally do more acquisitions.
Mhm. Mhm.
Uh, so it's but the core idea was to stay in these core markets, West Coast markets. We've had opportunities to go to Phoenix, we've had opportunities to go to Las Vegas, and buy cheap and or buy for cap rates that were significantly better than the West Coast. And if you look at those markets, they're timing markets because they get you get you can get in at some point. The growth is never there, the rent growth is never there, and then at some point in time, they overbuild because Phoenix has land forever.
A lot of desert.
And
I've seen it.
they have a very builder friendly government.
Oh yeah, yeah. Well, that's true. California, these markets do constrain supply. Yeah, I understand. The REIT is just such an integral part of that. It's interesting how you're able to shift strategies from, kind of build to core and go ground up, and then be able also to acquire great assets too. And you've done a tremendous job here, globally, in your empire. It's been fun to watch and seeing you go from 3,000 to 65,000, and yet you've also disposed of property too along the way, right? You've been entrepreneurial that way as well, and so you see opportunities both for acquisition and disposition. It seems like.
Oh, absolutely. This last year we sold almost $600 million of real
Wow.
estate, and I was this is sort of contrary to what I said earlier. What we sold was almost all core urban stuff. We
Yeah.
sold a property in downtown Los Angeles, in downtown San Francisco, and in
Hmm.
downtown San
Yeah.
Jose.
Across the street here.
Yeah, yeah.
Yeah.
So yeah, and partly because there were still people either coming out of exchanges. Actually, several of the buyers were Asian buyers who
Hmm.
had money that were trying to repatriate it, or not, to take it out of their home country into the U.S.
Sure.
And so they weren't sensitive to cap rates or to yields,
Hmm.
and we sold those properties at very, very low yields.
Yeah, let's talk about that a little bit. On an industry trend, cap rate compression. My goodness gracious, it's gone. From almost 4.5 to sub three to 3.5. Not sub threes, but 3.5. I think realistically, what's your take on that? I consider myself very sophisticated, yet at times I get lost in the cap rate, kind of equation. Maybe from a generic purpose, what do you, why is this happening? Why are we seeing, you'd think with lower rents that have, because of the pandemic, intuitively you'd say, well, gosh, maybe, we've lost value, but it seems like we've made some value up in existing product from cap rate compression. What's your thoughts on that?
Well, I think that's right, and I think and frankly, we haven't bought anything during this period, so we're scratching our head a little bit too, and that's partly why we were net sellers instead of buyers.
Sure.
But I think as we see the recoveries coming, again, these 3.4, 3.5 caps are really based on this current rent rolls. And if you look at what's the expectation that rents come back to where they were, and so if the rents come back, they're not 3.3s, they're really 4.25, which is kind of where we were before the pandemic.
Right.
And so I think that's really what's happening. We're just seeing, hey, it's 3.5 on today's rents.
Right.
And they say that doesn't make any sense. But if you look at the REITs, where our share price is today, and we just did uh, it's a- forgive me, it's either a 7 or a 10-year bond deal,
Mm-hmm.
$400 million at 1.8%.
Mm.
Uh,
Heyo.
so, and you think about that and you think of where our share price is. I mean, our cost of capital is very low. And so if we
Right.
can lock in our cost of capital and then match it with a existing acquisition that grows, it works.
Right.
And I think that's way a lot of these, REIT funds and just real estate funds that aren't REITs, in the private world are looking at it.
Yeah, that's a great explanation. Republic has roughly about 1,000 units, some of which with you all, and we're looking at, we've looked at some sales opportunities, and then just intuitively, I'm like, wait a minute, this is a down market, even with a lower cap rate. Why would I want to sell? And I've talked with Richard Kramer about this a lot, and my partnership, and depending on which market you're in, and San Francisco's seen, a lot of decline, obviously, in rents too. San Jose's had its fair share, but I tend to agree that, holding now with this incredible amount of money that exists. I mean, I've never seen so much money on the debt side, and all these new debt funds that have been created, like a grand old investment firm like KKR, for example, is now in the debt, the debt game for commercial real estate. And and they intend to do well. And then, of course, you have the larger ones like the Goldmans, and then you get back to the traditional agency financing, which a few years back was, well, hey, that's fantastic. COVID kind of changed some of the details of that game. So now everyone's moving to this, kind of bridge interim financing, and it is really competitive. And it's fun to, be able to say, all right, well, there's an avenue now. I remember the Great Recession. We would all prayed for this kind of financing in the Great Recession, and now it exists. And it really kind of strengthens what you were saying about the core being, a long-term success, because if the core continues to move back, we get people back in transit, we have that critical mass. You're absolutely right that the cap rate compression will go the other direction, but you'll have a higher NOI and a much healthier overall economy. So I'm sure our guys in the office game would like to have this opportunity. I know office is kind of struggling a little bit to find some of this capital, and retail in particular has just been brutal in hospitality. So it is nice to, at least from the apartment side, to have a little bit of something we didn't have in 2009 and 2010. Yet for me, it feels like 2009, 2010. And in the sense that we're ready to kind of take off again. Do you have any kind of parallels to that feeling?
Well, I'm not sure. I think back on that, and that was just really a financial collapse. And you just, there were projects just couldn't get financed. I mean, there was just financing was out there. And where today it's really the financing the market is, healthy. There's lots of dollars, as you say. And it's really it's a demand and supply, or more demand, issue. And just the economy. The economy has been, held down. So I mean, in a sense, they're similar just because there's just stress, but it's different stress. And I remember in back in those days, because we are a REIT and because we knew that the underlying values of the real estate was still there, even though all the REIT stock prices got crushed. And so we actually went out and bought other apartment companies' bonds, which we knew their real estate. We knew their real estate had value, and we were buying their bonds for yields of 15, 16% because the market just wasn't there for debt. And so it turned out to be a really interesting opportunity. We weren't going to buy real estate at the time, but go out and buy your competitor, which you knew their real estate, you knew the real estate was solid, and get those kind of returns. It was a very interesting move.
Good move indeed. I do remember back in those times saying that the existing apartments were starting to trade, and we mentioned cap rates. You started seeing that kind of happen, and it all kind of took off. And that's where I'm trying to draw the parallel to that time is that we had depressed rents back then, and so now we're like, oh, you use the word pre-pandemic, which, oh God, I hate that word, right? Because everyone wants to be pre-pandemic, not just because of real estate values, but because of life in general. But it's interesting that my parallel to the the economic cycle is, will we start seeing the rent increase, to a point where we were back to pre-pandemic levels? And it seems like everyone's projections are anywhere from 2023 to 2025, right? All the great economic experts. And it somewhat feels the same to me. And I remember looking in 2009 and San Francisco's, people forget San Francisco and their office market was devastated in the Great Recession. And yet they rebuilt themselves as a tech titan, and candidly stole a lot of jobs from Silicon Valley, even tried to steal Silicon Valley's kind of moniker. Um, so it does somewhat feel that way to me. And I say this in the most optimistic term for everyone out there that, as Keith mentioned prior, the demise of the Bay Area and California is greatly exaggerated. So, well, Keith, it's been a fun journey for you. I guess as a young Keith Guericke, did you think you would ultimately end up as a chairman and then president of a major real estate investment trust? Did young Keith Guericke think he'd meet someone like as dynamic as George Marcus? I mean, what would young Keith Guericke think about where maybe older, distinguished Keith Guericke is today?
He would have been very happy to have those views. When I grew up in Oregon, I went to school in Oregon. I graduated in 1971, and unfortunately, in 71 we were in a sort of a recession. And actually, it was interesting because everybody who graduated in 70, and I was an accounting major. Everybody who graduated in 1970 got great jobs in the Northwest, and so I graduated in 71, and so I wanted to stay in the Northwest in Portland or Seattle. That was what I knew, and California sort of had a bad name. There was bumper stickers all over Oregon that said don't Californicate our state." So I said, God, I can't go there. That must be a terrible place. And I'd really never been in
They're saying
California.
that in Austin now.
Yeah. And so, I had job interviews in Portland. I didn't go anywhere. I went to job interviews in Seattle, didn't get anything. So he said, well, I better go to California. So
Calling down south.
so I went to California, and I got a job with a CPA firm. Well, I was a senior. I was still graduating. And then the Vietnam War was still raging at that time. And my younger brother had a draft number of like 110 or something like that. And he got drafted in January. And I was graduating in June, and my draft number was like 186. And I thought, oh shit, they're going to get me.
Mm-hmm.
And so I joined the Army Reserve. And so in May, I went to boot camp and then to AIT. And then about August, I get a letter from the accounting firm that I had a job with, said, sorry, we lost some clients. We got to pull our job offer. And I go crazy. I said, I'm in the military. I'm serving my country. You can't do this to me. And so they said, calm down. We'll help you. So they set up a bunch of interviews for me. And I got a job with Kenneth Leventhal and Company, which they were a real estate focused CPA firm. And they did most of their REITs or their audits were home builders. So I got a broad exposure to real estate through Leventhal, and then and
Then along comes George.
Well, no, actually, yeah, but what happened is after about 6 years of public accounting, auditors are not loved.
Well, because you work too much.
No, because your clients hate you
Well,
because
that's
you're
true.
an auditor. You're an auditor. You're coming in to dig out, and a lot of the stuff we did. So in that period of time, there were a lot of troubled companies. So we sort of got into the workout business. sort of working for the banks, trying to
Oh, you're right. You don't like working for the banks.
fixing these companies. And so the company, you go in and the company hated you, everybody hated you. So I said, I got to get out of this crap. And so I said, I got to find a private industry job. And so I had a couple interviews, and George was one of them. And he was an impressive young man. And he convinced me that it would be the right thing to do to come to work with him. And I did. And I'm so happy I did.
George is just an incredible, pioneer, even and probably as relevant from the day he started to to today. It seems like his arc, never ends, right? I mean, whether it's been, founding, successful brokerage, companies to obviously the home building and then the REIT, and then not to mention he's one of the most successful restaurateurs in the entire, Bay Area, and he's one of the most respected, my kind of, I really admire him because he's the kind of Democrat, of course, I don't want to get too political, but he's the kind of Democrat that I would envision myself to be if I had his kind of resources. He always places them in the most, positive direction. And he just has a lot that's so just a fun guy, a lot of energy, even, now to this day. And that must have been just intoxicating, being able to start working with someone like that who just has all these plans. I mean, and you being an accounting background with all this, kind of more conservative experience, it seems like you guys were just a match made in heaven, in the sense that you really could balance each other and your business needs. I mean, how was that dynamic because you started there, and then you just, it's a rocket ship into creating Essex. And so how did that just come around that you started working in the home building side, right? And then it morphed into this eventually this incredible REIT.
Yeah. So I said it was a long journey. It started 1977 is when I went to work with George. And the reason I went to work for George is because he was just starting Summerhill and with home builder, and he needed some home builder experience. That's what I brought. And so that was it started out with one project, so it was not a big job. It was and so at this time, the other companies, Essex had already started. It was a small syndicating company, and Marcus and Millichap. And so I then started to do the controllership for all the companies. And so that's how
You were doing the controller for all the companies?
Yeah.
Wow.
Well, but they were small. I mean,
Right.
let's remember 1977. Essex has a few deals, and Summerhill had one project, and Marcus Millichap. Now I think it has over 100 offices
Oh, yeah.
across the country, and at that time there were three offices: Palo Alto, Sacramento, and San Francisco, which soon became Houston and Phoenix and Denver, and then that from there it just took off. So yeah, so 1977 to probably 1982 or three, I was pretty much just the controller, accountant, helping the company, working, helping with financing, helping with tax planning, all the things that typical finance people do. And then at some point in time, you talk about the partnership between George and I, but really there was Bill Millichap was a very important man in the mix, and he really was the guy who drove the success of Marcus, the brokerage company, which originally was GM Marcus and Company, and then ultimately became Marcus and Millichap, which now is also a public company. So yeah, interesting. Yeah, so it evolved, and then so George was the brains, and Bill sort of ran the side that was the brokerage and the service side, and I got involved with the asset side, which was Essex and Summerhill, and then in the early 91, 92, we the RTC days came around, when all the SNLs were going down, and the government was putting together these huge packages of apartments. They were actually well laid out. It was either apartment package or a office package.
You're
And
selling those off then?
yeah, they were selling them off, but
Yeah.
they were bidding them. So, they were, putting packages together that were worth, hundreds of millions of dollars. And we're still, again, we were pretty small. And I had talked to George and Bill about, we ought to try and bid on one of these. And they said, we don't have that kind of resources. And I said, I think if we can win these, we can go back to New York and we can find financing very quickly. And so, they trusted me, and we put up $1 million of our own money, and
Wow.
and actually won one of these with just I don't know, $300 or $400 million. It went back to New York, and literally within 3 or 4 days found the financing for the whole thing, and equity and debt, and that sort of got the wheels turning about public markets. And then ultimately we were approached by several different investment bankers about, you've got a portfolio, you got to think about going into the REIT, forming a REIT. And, we spent a fair amount of time thinking about it, did all sorts of spreadsheets comparing if we do a REIT and grow this far, this much, and if we do just our own private stuff and we maybe don't grow as fast, but how will the end look? And we struggled with it because I didn't understand what happens when you go out at 1950 and your stock price goes to $320.
Mm-hmm.
It doesn't matter that you own less of the company, because the return on the original investment is just so great.
Right.
So it became very it was an interesting move. It was a struggle at the beginning, but it was very well worth it as time went on.
Yeah. It's been an incredible story that and that you've been just, part of that and what it's grown to today. And actually your successor, right? He's still in charge. The great Mike Shaw, right? He took over for you. I'm trying to remember the year, not that long ago.
Yeah, 2010.
Yeah.
Yeah.
And geez, it's been 11 years now. And it's been interesting to watch the change. You guys have acquired, large companies and over that time, and just pick up the market share. And yet you're so West Coast centric. That's what I love about it, because, real estate is so local. And it's even hard sometimes to figure out a business plan in a neighboring county, not to mention. And so you've been tried and true, right? Essex has been very tried and true where it wants to invest. And, talk about that a little bit. And I think that gets back to who you are and who George is.
Yeah. Yeah. I've got, when we first went public, I had a sign on my desk that basically said, "Stay disciplined." And that was an important thing. And we've tried to stay disciplined through this whole process. And you're right. I mean, we acquired BRE, which was a $4.5 billion deal. We did some smaller deals. We did a deal with a guy down in San Diego that had 4,000 units, and so we didn't just grow one property at a time, and that would be difficult. And then staying West Coast focused, I think we are the only public REIT that is West Coast focused.
God love you.
And so I think that makes us unique. I think that the investors in the world that have recognized if you think about the economy in California, and if you put California and Washington together, I think we're the 5th largest economy in the world. And we're driven by tech. And yes, some other markets are starting to become more tech oriented. Austin, comes to mind, and New York City is actually becoming a tech center. And you've got, Colorado Springs is, but it's all right here. It's still all here.
Mm-hmm.
And
undersupplied.
Yeah, well, yeah, and it's interesting because we still have an undersupply of housing, even though at times in certain little pockets we oversupply, right? San Jose, in certain little pockets we've oversupplied, but overall we are still an undersupplied market. We're still creating tremendous jobs, and And the talent is here. I mean, the talent is being created. It's continued to be turned out by Stanford, by UC, and those people, they come from all over the world. They come here, they get a taste of it, and they're not going to go back. They're going to stay here. They're going to stay here, and they're going to, and just think about how many new companies have been created here that, weren't when you and I started, weren't they were the concept wasn't even here.
No.
I mean, think about this. Think about this cell phone.
Yeah.
Um, I remember, I don't know what it is, 80 something, 85,
Mm-hmm.
the first big, suitcase cell phones.
Oh yeah. My dad had one in
Yeah.
a Cadillac.
Yeah. And now you have this little box.
Yeah.
It's got a camera, it's got a computer, it's got a, it's amazing. And then you think about all the other stuff that's been created. Think of the pandemic, think about Zoom, what's happened
Oh
here.
yeah.
I mean,
San Jose company, Zoom.
yeah. And there are just tremendous numbers of talent and the creation of jobs and the creation of new technology. California is going to be here for a long, long time.
No better place. Well, listen, this has been fun. I always am amazed how fast this goes, and I'm happy. So, how are things going in your personal life? I know you built a new house, and you're enjoying that, I hope.
Absolutely enjoying that. I got a new a puppy during the pandemic.
Oh, okay, great. I'm a
And
dog guy.
and it's been fun. She's 8 months old now, and this morning when I got up, we go out the back. We have a little vineyard out in the back. And
Yeah.
I can hear peep peep, and I knew there were turkeys out there. So I said, "Get the turkeys," and she went after them and chased them all away. So
Good. So your wine label too, right? You got a wine label as well?
I've got to create one. I've got right now. I just label my bottles as the year that it was produced. So one of these days I'm going to create something very interesting.
Well, good. Well, and we appreciate that. I can't wait to get a bottle of that. But, on behalf of all the friends and family of the Republic family of companies and Richard Kramer, thank you and Essex for everything that you've done for us. I had Kay Swenson in here in our last podcast. The Swenson family, really kind of helped us get our start on the West Coast in terms of credibility in a project. But I think Essex has provided that lift and separation for Republic to brand itself and to have projects that are that are large and that are successful, and in large part because Essex and its investment in those projects. We've been partners. We've sold properties to each other. We've done preferred equity. We continue to work together, and it really it's all because of you and guys like Craig Zimmerman and John Udy and Mike Shaw and of course the great George Marcus. And we're forever just grateful for that relationship, and we know that it's performance based, and that's what makes it so fun, right? That it's like a team, like the Giants last night. They rallied back and they won. They won it as a team, and I feel like there's a sports analogies really applied to our relationship with Essex. So thank you for everything, and I'm excited for your future, and it's been great to talk about the past and the present and everything we're working on. So thank you for everything.
Keep throwing strikes, Michael.
Thank you. I will. Well, ladies and gentlemen, that's the Van podcast number 2 here, and rapidly approaching Q4 or Q3 2021. Please join us next time. We'll announce our Q4 guest, and you guys have fun and make some money out there.